Hello everyone. Today in this video lecture I will cover lecture 6 PowerPoint slide and lecture 7 PowerPoint slide. So lecture 6 and lecture 7 PowerPoint slides is basically covers the materials that are included in chapter 4 of your book. Now on eCampus you will see that there are two separate lectures, lecture 6 and a separate file for lecture 7, but for this video purposes I just combined those two lectures, and I'm going to cover the materials in lecture 7 and lecture 6 in this video lecture. So basically in your eCampus you will have two separate files, PowerPoint files, lecture 6 and lecture 7, but this video lecture is basically going to cover the materials for chapter 4, which is included in lecture 6 and lecture 7. Okay, now there will be some materials that are included in those lecture 6 or lecture 7 files that I will probably not speak about today, maybe one or two topics. That's because those are very self-explanatory. It's just reading material. If you read those lines or read those slides, you will understand what it's trying to say. It basically tells about the background of the US economy, and it just gives you a little bit of idea of how the economy operated or how the government in the US was involved. But those topics are again self-explanatory. If you read it you should, but the ones that need a little bit of explanations that have been included in this video. And again I wanted to be clear that this video lecture contains explanation or covers the materials for lecture 6 of the PowerPoint and lecture 7 of the PowerPoint. Okay, so this lecture mainly talks about the government role in the economy, but particularly it also focuses on the US government, including federal and state government. Okay, now so far we have seen that we want the economy to operate freely, consumers and producers interact, consumers have demand, consumers come up with demand, producers come up with supply, they interact in the market to determine the equilibrium price and equilibrium quantity. But then even still today we see there is a lot of activities in which the government is involved with in our economy, and that's what we are going to try in this, which we are going to try to understand in this video lecture. Okay, so social balance, this is a term used in chapter 4. This basically means it's a way to understand or to begin to understand the growth of the government in the economy. So basically social balance tells us how much of the resources are allocated for private expenditures and how much of the resources are allocated for public expenditures. So it basically gives us a breakdown between the private sector and public sector. Okay, so in a free market society you would assume that the public sector is going to be a very small size, whereas private sector is going to be large. Most a free market society, government intervenes very little in the market, right? So we will assume most of the businesses are owned by the private industry, and therefore private sector will probably dominate most of the social balance. In the US, based on our GDP, 1/3 of total spending is by the government and the 2/3 is from the private sector. So 33.33% of the total GDP is because of government spending and government activities in the economy, and the remaining 66.66% is by the public expenditure. Now that's quite a big portion of the total expenditure. If we think about it, 33.33%, that's pretty huge. So that gives us an idea that even though the US has a free market economy, the government still has a big role to play, or the government still plays a big role in the economy, and that affects our everyday life. Okay, so so social balance is, again, it gives us the breakdown between how much is for public sector and how much is for private sector. And if we want more public goods are basically goods that are provided by the government to us. Let's say if we want the government to provide us free healthcare, then this social balance will change again, and probably public sector will then move up from 33% to 50% or 55%, and private sector will probably be 50% or 45%. Okay, so if we want more activities from the government, if we want more goods or public goods or goods, if we want the government to provide goods and services, then their portion will go up in the social balance. The public sector portion in the social balance will go up, because the government is more involved with the economy, and as a result more taxes will be imposed, and more debts will be incurred. Because how do government, or how does the government incur the expenses? How are they spending? Where are they getting the money that they are spending? If they are providing us free healthcare, where are they getting the money from? They are basically getting the money through taxation. So taxes will go up. Our income tax, property tax, or other corporate gain tax or capital gain tax, these will go up. That will finance the government expenditure. Or the government can also take debts from banks or Federal Reserve or other types of countries and finance these public sector activities. Okay, so public sector is dependent on the tax revenue, whereas private sector is basically independent. Okay, public sector is dependent on tax revenue as well as or borrowing from the private sector. Okay, so public sector, when we talk about public sector, we refer to all forms of government. It includes federal, it includes state, it includes state and county level. Okay, federal, state, city, county, all levels of government are included in the public sector. Now if I ask you which level of government has the highest level of expenditures, then probably we will say federal, but the reality is the largest expenditures are actually made by the state and local government. Well, yeah, federal government does make expenditures, but based on the numbers we have, the local and the state government has the largest expenditure portion in the public sector. Now, private sector, we know what private sector means. It's basically the economy. The private sector of an economy is the spending or allocation of resources by consumers and businesses. Consumers and businesses interact freely in the market to determine the equilibrium price, and it is largely market-oriented system. And consumers will come up with demand. Based on that, producers will produce goods, and then they come and meet in the market, and the equilibrium is met. We have to understand the difference between public goods and private goods. Okay, so again, when I said public goods are goods or services that are provided by the government to the citizens of a country. Okay, the definition of public good is these are goods and services that are provided by the government to the citizens of the country. Okay, and private goods are goods that are provided by the businesses, by the private sectors. Okay, now if Walmart is selling a good, that is a private good. If Target is selling some goods, that is a private good, because these are sold by private businesses. And public goods are goods like if the government is providing free healthcare, that's a public good, because this is provided by the government. Okay, so some of the characteristic of public good is that it is accessible to all. Everyone can get access to public goods. It's not like public goods is only available for the poor people and the rich people cannot get it, or it's not like only the upper class can have public goods and the rich people and the poor people cannot have it. So it's not like that. In case of private goods, let's say a diamond ring is very expensive, and only the people who can afford it can get diamond, but not the normal ordinary people, right? But public goods are goods that are accessible by everyone can access it. Okay, so one of the characteristics of public good is it is accessible to all, and that's why public goods are called inclusive, whereas private goods are exclusive. Okay, so only if you can pay for the good, you will get the private good, like diamond, whereas public good is inclusive. Everyone enjoys the benefit of the good regardless, okay, or whether they can afford it or not. Now, an example of public good again would be the street light. Think about it. The local government is providing street light, and it is accessible to everyone, right? It is inclusive to all the citizens. Whoever is passing through the road is going to enjoy the benefits of the light. And nobody has to directly pay any cost for the street light, right? So that's why one of the characteristic of public good is it's inclusive and it is accessible to all, whereas private goods are exclusive and you have to afford to obtain it. Okay, now another characteristic of public good is that public goods are available without any direct cost to consumers. We do not have to pay for public goods directly, right? Let's say I fall sick, I have a heart attack, and I call 911. The police will come, and the paramedics will come and will take me to the hospital, but probably there will be very little bill, or there will be no bill at all, because that is a public good. The government is providing us that service, and we do not have to directly pay any fee or any price for that. Whereas for private goods, if we try to buy something, let's say we try to buy a cloth or we try to buy a shoe, we have to pay for that. It's not free, right? So when we say direct cost, because there's no price, although there is no price, but we do pay for it indirectly in terms of taxes, right? People pay taxes, and using those taxes, government is providing us public goods such as street lights, paramedic services, other types of defense services, other types of public goods. One more thing that you need to know is public goods do not have marginal cost, whereas private goods have marginal cost. So if you consume one street light and then you consume the second street light, your cost does not accumulate. So there is no cost for consuming the second unit, right? If you call paramedics today for illness, and then you call paramedics tomorrow again for another accident, you're not going to incur any additional cost. So public goods do not have any marginal cost, but private goods do have marginal cost, right? You buy a leather jacket from Target today, you pay $50 for that, and then you go back tomorrow to Target to buy another one, you still have to pay $50. You have to pay another $50. So there is marginal cost for that additional private good. But for public good, if you're using the additional good, if you're buying or if you're trying to use the additional good, there is no marginal cost. Okay, again, example is the cost of national defense. It is available to all and has no additional cost by including more people. One last characteristic of public good is that public goods are non-rival, but private goods are rival. So this is important, and you have to know this. What this means are, when I say public goods are non-rival, means there is no competition between the clients. It does not mean that if I use the public good, it will not be available to Tom, or it will not be available to Sam. Okay, so it is not rival. There is no competition between the consumers, right? Again, let's think about street lights. If I go and stand under the street light and I'm enjoying the benefits of the street light, it does not mean that Tom, who's passing by the street, he will not get the benefit of public good. He will also get the benefit of public good, and I will also get the benefit of public good. So these types of goods are non-rival. Okay, consumers do not compete with one another to get this type of goods, whereas private goods, they are rival, right? Let's say there is a new diamond jewelry, and I go and buy it. If I pay for it and buy it, then that particular diamond necklace will not be available for anyone else, right? Because I paid for it and I bought it. Now that one is not available for anybody else. So there is competition. Whoever can afford it, they will be able to get it. So there is rivalry between the consumers in case of private goods. Okay, so these are the characteristics of public goods. Again, you have to know public goods are inclusive and it's accessible to all. Public goods do not have any direct cost to consumers. Yes, there can be indirect cost in terms of taxation, but there is no direct price you have to pay. Public goods do not have any marginal cost, and public goods are non-rival, meaning that the consumers do not have to compete with one another in order to get the good. Or in other words, consumption by one consumer does not prevent the simultaneous consumption of the another consumer. So that's what public goods are. So I might ask you, what are all of the following are characteristics of public goods except, in a multiple choice questions. Okay, so make sure you know the characteristics of public goods. They are accessible to all, inclusive, no marginal cost, they have no direct cost, and they are non-rival. Okay, so moving on, private sector. Now we focus on private sector a little bit. Private sector income can be measured in two forms. The first one is called the personal income distribution, and the second one is called the functional distribution of income. So under the personal distribution of income, it is basically the income after taxes that an individual can take. They can either spend it or save it. Let's say your gross salary is 4,000 per month, but then you have to pay income tax and social security tax and Medicare taxes, and after that your leftover income is 3,200. So that's personal income distribution, and using that 3,200 you can either spend it or you can save it. Okay, you can use the money to spend, consume it, buy stuffs or buy goods and services, or you can save the money. So there's two things you can do. Okay, now based on data we have seen that in the US most of the income earned by the people, most of the personal income distribution, or the personal income that people get, most of the people, 59% of their income is used for services. So let's say if my income is $100, then on average I spend $59 on services. Now services includes educational services, childcare services, medical services. So I spend 59% of my total income on various types of services based on the US statistics. Okay, then 29% of their income is spent on non-durable goods. So what are non-durable goods? You need to know the definition of non-durable goods. Non-durable goods are any type of goods that last less than 3 years. So these goods have life expectancy of less than 3 years. Okay, an example would be grocery, food items, clothing. Usually food items do not last more than 2-3 months, right? Or clothing, maybe we will wear a t-shirt for two years or 3 years max. We will not wear it after 3 years, most likely, so unless it's a very expensive clothes, right? But non-durable goods are basically goods that last less than 3 years, and 29% of people's income are spent on these type of goods. Okay, and then the remaining 12% of the income is spent on durable goods on average. So the remaining 12% is spent on durable goods by Americans or US citizens. Now when I say durable goods, what are durable goods? Durable goods are goods that last more than 3 years. So the life expectancy of these type of goods is more than 3 years. Okay, so an example would be car, automobile, vehicle, or furniture, or television. We usually use television more than 3 years. We use cars more than 3 years, right? So those are durable goods. So most of our income is spent on services, followed by non-durable goods, and the final segment, or the smallest portion of income that we spend on, are durable goods. Okay, on the other hand, we have functional distribution of income. Functional distribution of income is based on the factors of production and the income that comes to each. So again, the 4 factors of production are land, labor, capital, and entrepreneurship. Okay, so in the US economy, how much income comes to land owners? In the US income, how much income comes to the laborers? In the US economy, how much income comes to the capital holders? And in the US economy, how much income comes to the entrepreneurs? So basically this is based on the factors of production and how much each of these factors of production earn. Let's say land, the land usually the income that landowners earn is rent. The income that labor earn is wage. The income that capital holders earn is interest, and entrepreneurs earn profit as income. We talked about this a little bit in the first chapter, but again, this is just a refresher. We basically want to know how much total rent comes to the landowners, how much total wage comes to the laborers, and so forth and so on. And based on the data, we see 71% of the total national income come as wages to labor. So most of the income that we see is as wages, the work that we do, the salary, the wages that we earn, that is 71% of the national income. This is followed by profit, so for 23% of the income is earned by entrepreneurs as profit. Then landowners earn 5% of the total national income as rent, and then capital holders only earn 1% of the total income as interest. So this is just some basic data that we have in terms of the national income of the US economy. Okay, there's one topic that the book talks about, is called the net worth. Now, if you have taken an accounting class, you probably already know what net worth means. But net worth is basically defined as the sum of the market value of all the assets owned by an individual minus all the liabilities that individual has. Okay, so basically net worth in CNN or in Fox News, you probably heard Brad Pitt has a net worth of $11 billion, or let's say Tom Brady has a net worth of $10 million. So what does this net worth of $10 million means? What it means is it's all the assets that he owns. Assets meaning anything that he owns, like house, cars, furniture, cash money, everything, all the assets that he owns minus his liabilities. Liabilities means like his home loan, his car loan. So we add all the assets, then we subtract all the liabilities, then we get the net worth, and that is what it means. Okay, so net worth is given by the formula assets minus liabilities, and I'm gonna do a quick example related to net worth, because there might be one in your exam and in your homework. Okay, so let's say you're given with this following information. This is an example that we're doing for net worth. So let's say for Nafis, which is me, the following information is given. Now these numbers are definitely hypothetical. Don't think these are actual, but I'm just using as an example. So for Nafis, the following information is given. Nafis owns a home and the value of the home is 300,000. Okay, now there is a loan on his home and the current balance on that loan is 240,000. Okay, then he also owns a car and the value of the car is 30,000. There is a loan on his car as well, and the balance on the car loan is 20,000. Okay, now he has some cash with him, some cash money of $7,000, and then he has some credit card bills, and that's equivalent to $2,000. Okay, now given this information, what is the net worth of Nafis? That's a question. I can give you this information and then I can ask you to calculate the net worth of Nafis. Okay, or whatever example I give. So again, based on the slide, we know that net worth is given by assets minus liabilities, right? So let's first, given these statements, let's first try to calculate the total assets and then calculate the total liabilities, then we try to compute the net worth. Okay, so let's first focus on assets. Okay, so the first one we are given is Nafis owns a home and the value of the home is 300,000. So that's something he owns, right? So that's an asset for him. So we will include that as an asset, plus the loan on his home, and it has a balance of 240,000. Now loan is something that he has to pay back. So that means he does not own this, or it's not an asset for him, it's a liability. So we will not include it under asset. Then the next one is a car. He owns the car, so that's something he owns, and we are going to add it here, 30,000. Again, the loan on the car will not be included because that's a liability he has to pay back to the bank, so that is not included. Then we have cash of $7,000. Now that's something he owns, he has that money, so he owns cash, so we will add 7,000. And then he has credit card bills. So credit card bills are definitely not assets. These are something that he needs to pay back to his credit card companies. So this is not an asset. So it will be included under liability. So far we know the assets are his home, his car, and the cash that he owns. And we will add up all these numbers and we will end up with $337,000. Okay, so now we know the total assets. Now we calculate the total liabilities. Okay, so liabilities will include his loan on his home. That's a liability. He has to pay back to the bank. So we will include the liability on his home. We will also include the loan on his car because he has to pay back to his bank. So 20,000, and we will also include the credit card bill because this is something he has to pay back to the credit card company. So when we add up all these numbers, we get $262,000. Okay, that's his total liabilities. So his total assets is 337,000. His total liabilities is 262,000. Now what is his net worth? Well, we know the formula. His net worth is given by assets minus liabilities, which is 337,000 minus 262,000, which is equals to 75,000. That is his net worth. So this is how you calculate net worth. And when we talk about the net worth of celebrities or politicians, this is what we are doing. We are taking all their assets, adding them up, and then we are taking all their liabilities, adding them up, and then we subtract the liability from the assets to get the net worth. So you might have a similar type of problem in your homework or in your exam. Okay, so hopefully this is clear to you guys what net worth means and how you can calculate net worth. So moving on, when an entrepreneur starts a business, they can start a business in three different forms. Basically, there are several other forms, but these are the three main categories that they can start business. The first one is called sole proprietorship. Sole proprietorship means I'm the 100% owner of the business and I only have one location and that's it. Okay, I am the 100% owner. No, there are no partners. I own all the assets of the company. I own all the liabilities of the company, and there's nobody else involved in the company. So that's sole proprietorship. Okay, then we have partnership. Partnership is when there are two or three partners. Let's say there's a business where I am 50% owner and Tom is 50% owner, or there's a business where let's say I am 30% owner, Tom is 30% owner, and Stacy is 40% owner. That would be a partnership. It's a business where the assets and liabilities are owned by two or three partners. And finally, we have a corporation, which are basically huge, like if we talk about Samsung, if we talk about Apple, if we talk about Dell, then we are talking about corporations. Okay, these are huge. There are a large number of owners, large number of shareholders. There are a lot of owners. Okay, lot of shareholders, owners, stockholders, and the corporation is separated out from personal assets and liabilities. Okay, you might have ownership in the if you might have ownership in the corporation, but your personal assets and liabilities are separate out from the corporation. But in case of sole proprietorship and partnership, it's also part of your personal assets and liabilities. Okay, so corporations are large, sole proprietorships are very small in size, and partnerships are somewhere in between. Okay, now corporations produce, like when we look at the output in terms of the number of output or in terms of the quantity of the output, we will see that 84% of the output is produced by corporation, and only and in terms of the number of firms, they only account for 20%. So you can think, Samsung, they produce thousands and thousands of cell phones in a year, right? So they produce, in terms of quantity, they are 84%, but in terms of the number of firms in an economy, they are 20%. On the other hand, sole proprietorship, in terms of number of firms, 70% of the firms in the US are sole proprietorship, but in terms of output, how many output they produce, what's the quantity of output they produce in the economy, it's only 5%. So these are small shops, small grocery shops, small convenience stores, small gas stations. These are sole proprietorships. Okay, so there are a lot of mom and pop shops all around the country, but they only contribute a little bit towards the economy, whereas corporations, there is only one Samsung out there probably, right? But they are contributing by a large margin in terms of output to the economy. Okay, and partnership is somewhere in between the two. They account for 10% of business units and also produce 10% of the output in the society. Now these forms of businesses such as sole proprietorship, partnership, and corporation, they have advantages and disadvantages. So I wanted to do a quick table so I can explain you what are some of the advantages and disadvantages of these type of corporations. This table is also there in your book, but it will help you to understand it's easier, and it will help you to understand each of these structures. Okay. So let's say we have the three structures. First one is called sole proprietor. Okay. Second one is partnership. And third one is corporation. Okay. Now we look at the different characteristics and what each of these and which characteristics qualify for each of the structures. Okay, first one is easy to organize. Okay, that's the advantage, easy to organize. That is for sole proprietorship and partnership, not for corporation, right? I as an individual, I'm going to open a business and it's very easy. There's not too much complication. I can just go and create a corporation. I can just go and create a sole proprietorship tomorrow because I'm the 100% owner. There's not too much dispute. Partnership, it's also very easy because it's between 2 or 3 people and they can easily come to an agreement to form a business under partnership. But corporation is difficult to organize. You have to get a lot of shareholders, lot of people to come together and in a mutual agreement in order to form a corporation. So that's one of the disadvantages of corporation. But advantage of sole proprietorship or partnership is easy to organize. Okay, then we have another characteristics called permanence. Okay, so what does permanent means? Permanence means how long the business will exist in whether it will exist after the death of the owner or whether it will not exist after the death of the owner. Now sole proprietorships, they are not permanent. They are not long lived. Partnerships are also not long lived, right? Let's say I own a business, I own a small grocery store, and I under sole proprietorship, and then something happens to me and I die. Probably the grocery store is going to close down. Nobody else is going to take up the responsibilities, or nobody else is there to look after my business, so it will probably close down. So there is very less permanence for sole proprietorship or partnership. But for corporation, the permanence is there for a long time. Even if the owner passes away, there's CEOs, or even if the CEO passes away, there will be some other person becoming the CEO and the CFO. Okay, so permanence, in terms of permanence, corporation exists for a long period of time, and they probably exist forever, until unless they go bankrupt or they have financial issues. Otherwise, their permanence wise, it exists for a long period of time. The next one is characteristic is called specialization. Now again, specialization means that the business is specialized to produce a particular type of good or service. They are only producing a particular type of or particular particular type of good or service. Okay, now sole proprietorships, they are usually not specialized, right? A grocery store will have a lot of different items. They will have food items, they will have clothes items, they will have beer, they will have some small clothes, they will have some small souvenir items. So Sole proprietorship and partnerships, they are not usually, sole proprietorships are not specialized, but partnerships and corporations are usually specialized. Again, think about Samsung. Samsung is specialized in the production of electronics. They are producing TVs, telephones, laptops. So they are specialized in electronics. They are not producing clothes. They are not also producing food. They are only specialized in electronics. So specialization exists in partnership and corporation, but not in sole proprietorship. Then we have another characteristic called limited liability. This is a characteristic that exists only in corporation, which is a good thing. Sole proprietorship and partnership, there is no limited liability. If something is wrong with the business under a sole proprietorship, they will come after me personally, right? Because I own that business 100%. So if anything goes wrong, if I default on my loan on that business, the bank will come after me. So there is unlimited liability. Same for partnership, they will come after the two partners. But for corporations, there are so many shareholders that the liability is very limited, and your personal assets and liabilities are separated out from the corporations under corporation. So that's why this is a big advantage for corporation, is that liability is very limited. There's a lot of people, a lot of shareholders, and then you do not personally own the assets and liabilities. So bank will not come after your personal assets. They will only come after your corporation if something goes wrong, but not after you personally. Okay, the next characteristic is called money resources. So that means the sources of money. For sole proprietorship, I am the 100% owner, so I am the only source of money, so not too good. For partnership, there are 3 or 4 sources, because I just want to draw lines so it's clear to you guys. For money resources, this is an advantage for partnership or corporation. Again, partnership has 2 or 3 partners, so there are 3 or 2 sources of money. Corporations, there are thousands of sources. There are so many shareholders. Everyone invests in the market and therefore invest in the corporation. Therefore, the money resources are large. Then market power. Again, corporations usually have market power. Sole proprietorship and partnerships are small. They don't control much of the output, whereas corporations control a large portion of the economy's output. We just saw the example, right? We just saw the statistics. 84% of the total output comes from corporations. So definitely they have market power. They can control the total output of the economy, whereas a small grocery store, it's only a small portion, a small percentage of the total output of the economy. So market power for sole proprietorship and partnership is very less, but corporations such as Samsung, Apple, they have a lot of market power. They have influence over their price. So corporations have market power. And the final characteristics is called tax advantages. And again, partnerships and corporations have tax advantages. Sole proprietorships do not have that much advantage. Under corporations and partnerships, there are a lot of expenses that you can deduct from your income, so you pay less taxes on your net income. Okay, like you can take depreciation, you can take gas expense, you can take a lot of other things you can include under corporations and partnerships, and in an accounting class you will learn those. But under sole proprietorships, the items that you can list as expense are very limited. You cannot list everything as expense, or you cannot list most of the things as expense under sole proprietorship. But for partnership and for corporations, you have a lot of tax advantages. There are a lot of loopholes, and there are a lot of options available to you as corporation or partnership to take deductions. So these are some of the characteristics: easy to organize, permanence, specialization, limited liability, money resources, market power, and tax advantages. And we can see from here which which structure has those advantages or which structure lack those advantages, and based on this, if we are trying to start a business, based on these characteristics we can determine which one we want to do. Okay, so hopefully that explains you the different structures that businesses can have and the different characteristics they have. So moving on, there are also 4 different types of market structures. In a free market society, there are 4 different types of market structure. Now, when you take a macro class, you will learn about these market structure in details, but still in this class, you still have to know what are the 4 different types of market structures and what are some of their characteristics. Okay, like in micro class, each of these market structures, like each you will dedicate 1 chapter on each of these market structure, but in macro we just have to have a basic idea, and you might have 1 or 2 multiple choice questions from these type of topics. Okay, so there are 4 market structures. The first one is called the pure market competition, or also known as the perfect market competition. So pure market competition and perfect market competition, the main characteristic of this type of market structure is that there are a large number of producers and large number of consumers in the market. The products are homogeneous, or they are identical to one another, and there is easy entry or exit from the market. So businesses can easily enter the market, or businesses can easily exit the market. The products are identical, and there is a large number of suppliers, and at the same time there's a large number of consumers. An example would be the agricultural market. Think about the cabbage. If I am producing a cabbage and if Tom is producing a cabbage, they will taste the same, they will look the same, so the products are identical. Then there is a lot of farmers who will create or who will produce cabbage, so there is a large number of suppliers. Most of us buy cabbage and eat cabbage, so there is a large customers, and it's also there is easy entry and exit into the market, meaning like if I want, I can just plant a cabbage tree in my garden today, and then I can grow cabbage and sell it in the market. It's very easy in this type of market structure, and this type of market structure is most efficient. Consumer satisfaction is maximized, cost is minimized, and then output is maximized. So this is the perfect situation that we would like to have. An agricultural market is the closest to pure or perfect competition. Second type of market structure we have is called the monopolistic market structure. So the characteristic of monopolistic market structure and pure market structure or perfect competition are very similar. Okay, but specifically the characteristic of monopolistic competition are they have again large number of buyers and large number of sellers, or large number of consumers and large number of producers. There's very little barriers to entry and exit from the market, but the only difference between the two is that here the products are differentiated. They are not identical or homogeneous, they are differentiated. Okay, an example would be the restaurant industry. Think about the number of restaurants in the city of Dallas. There's so many restaurants out there, right? So there's a large number of suppliers. Almost before the coronavirus pandemic, we probably went to restaurant all the time, right? So there's a large number of consumers or customers for restaurant industry as well. It's fairly easy to start a restaurant business. You probably need to lease a place and just get a chef and get a business started. So it's not very difficult to start the business. So it's relatively easy, and you can, anytime you can want to close the business, you can close and get out of the industry. But the products are differentiated, right? Now, a Chinese restaurant offers different type of food compared to a Mexican restaurant, compared to an American restaurant, compared to an Indian restaurant, right? So within this industry, the products are differentiated, right? So that's how they will compete with one another, and that's how the products are differentiated: Chinese food, Mexican food, and American food. Okay, then the third type of market structure we have is called the oligopoly market structure. Now, under this type of market structure, we have a large number of buyers, but we only have a few suppliers. Okay, there's probably 5 or 6 or 9 or 10 suppliers or producers in the market, and they can control price. Okay, the producers can control price. There is limited competition, and it's the barriers to entry is hard. Now products can be identical or products can be differentiated under oligopoly market structure, but another big characteristic of oligopoly is there is high barriers to enter the market or high barriers to exit the market. Okay, example would be the airline industry. Okay, if we look at the airline industry, there is only a handful of airlines in the US: American Airlines, Delta Airlines, United, Southwest, Spirit, JetBlue, and a couple more, probably 10 or 11 airlines. But almost everyone travel. Most of all US citizens travel and probably take a flight to a vacation or to visit a family or for work, so there's a large number of customers but only a few handful suppliers. Also, it is very difficult to enter in this type of market, right? I cannot just go and invest to start an airline industry today. It requires a lot of capital investment, lot of skills, and lot of expertise, which not everyone can achieve. That's why the barriers to entry is very high, and this type of market structure is called oligopoly. Finally, the last market structure we have is called the monopoly. Monopoly is there is a large number of buyers, but there is only one single seller, and he controls, or that business controls the price. There is no competition at all, because there's no other producer. I am the only producer. Let's say if there's a certain product that I'm the only one that supply in the US, nobody else supplies, so I am a monopoly. There's no competition, so barriers to entry is very high. Nobody can easily enter this type of market. Example would be pharmaceutical company, some pharmaceutical company that produce specific drugs. Or another example would be in some cities you will see there's only one internet provider or there's only one electricity provider. So in that region, that company or that business is a monopoly. That is the single provider of that service. So these are the different types of market structures. We need to know them. I might give you an example, like let's say I will say restaurant industry has products that are differentiated. What type of market structure is it? Is it a pure market structure? Is it a monopolistic? Is it an oligopoly, or is it a monopoly? So based on this information, you have to select that. Now, so far we have seen that the government plays an important role in the economy. They provide public goods, but what are the functions of government? What are the official or economic functions of the government? Now, we are not talking about other types of functions. They can have war related functions, they can have other legislative type of functions, but in terms of the economies, what are the official functions of the government? So the first one is the government provides a legal framework. Basically, it provides a system of laws for businesses and individuals so that no one can take advantage of the other, right? So the government is there to make sure that the businesses are not exploiting the consumers. If they are, they will pass different types of laws, like the antitrust laws. So the businesses are broken down and they cannot practice unfair business rules and regulations. Okay, same way they are also there to protect the businesses. They want to make sure that the consumers are not taking advantage of the businesses. So they provide a system of laws for both the businesses and individuals that is critical for their rights. Okay, and it must be fair, and it ensures compliance with laws through enforcement. Government can come in and impose penalties on businesses if they are charging too high to the consumers, or if they are practicing unfair business practices. So that's one of the things. They provide a legal framework. Second function is they correct for misallocation of resources. So if there is a misallocation of resources, government can come in and correct that. How do they do that? They do that, government will reallocate resources whenever there is a negative externality or a positive externality that affects the economy. So what is a negative externality and what is a positive externality? So negative externality is basically when there is a transaction between me and Tom, when there is an economic transaction between me and Tom, and this economic transaction causes negative consequences to the other people in the economy. Okay, although they are not part of the transaction, it creates negative consequences for everyone else. So it is present when production or consumption inflicts cost on third parties not part of a market transaction. So basically, let's say I'm buying a good from Tom and I'm paying him, and but because of that transaction it is inflicting cost on other third parties who are not even part of this transaction. So that's negative externality. Okay, let me give you an example. Let's say I am buying a car from Tom. Tom is a car dealer and I'm buying a car from Tom. It's a separate economic transaction. I pay for the car and then I take the car home and I drive the car. So, but when I'm driving the car, I create pollution and I create traffic. And that is a cost to other people who were not part of the economic transaction. So that is a negative externality, and government can come and reallocate the resources to correct the negative externality. And we're going to go over those shortly. Okay, same way you need to understand what positive externality means. Positive externality means when there is an economic transaction between me and Tom, then because of that economic transaction third parties get benefit. They are not even part of the transactions, but they are benefiting from the transaction. Okay, so it is a benefit that is enjoyed by a third party as a result of an economic transaction. Okay, so an example would be, let's say you are studying medicine and you become a doctor. Well, definitely you get a degree and the college gets the tuition, so there's that economic transaction. But when you become a doctor, you provide social service, you help people to get well from sickness. So that is a positive externality. The society is benefiting from your services. So that's positive externality, and again government can come and try to reallocate resources to bring about more positive externality. Positive externality is good, negative externality is bad. So government can take actions during this type of externalities. So how do they correct misallocation of resources? So in case of negative externalities, government can try to solve the problem by using regulations, taxes and fines. Okay, now three ways they can do: taxes, regulations or fines. Okay, so let's say if I am buying car from Tom the auto dealer, and then the government comes and says if you buy the car you have to pay 10% extra tax to us. So probably that will discourage me from buying the car and I'll probably use public transportation. Okay, so that's one way I can reallocate the resources. Another is regulations. Okay, regulation means like Tom is the manufacturer of car, but the government comes and says, hey, in order to manufacture a car you need to put a catalytic converter in your car so it produces less emissions. So if Tom has to put a catalytic converter in the car, that means his cost of production will go up. It will cost him more to produce the car, so it will probably discourage him to produce more cars. So that's another way the government can reallocate resources in terms of negative externality. And finally, the government can also issue fines. If I'm driving car and if my car is releasing a lot of pollutants or gas, then the cop can come and fine me and give me a penalty. So I will be forced to fix my pollution issue or my gas issue. Okay, so these are ways the government can correct negative externality. Now, in case of positive externality, that is a benefit that the society enjoys. So the government would want more positive externality, right? So that's why government provides subsidies. Government subsidizes certain industries such as educational industry. They provide financial aid, they provide scholarships to people so that more and more people earn higher education, and as they obtain higher education they can provide more benefits to the society. So these are ways the government can correct the misallocation of resources to fix negative externality or to bring about more positive externality. Another function of government is to redistribute income. So government wants to make sure that the inequality between the poor and the rich is as less as possible. They don't want a situation where the rich gets richer and the poor gets poorer. So that's why they have different types of taxation. They use progressive taxing in the US. So which means the rich people will have to pay higher taxes and the people with lower income will have to pay low taxes. So that's one way they can redistribute income, because the tax money that they get from the rich people, they will use those tax money to provide various types of social security benefit or Medicare benefits to the lower income people. So that's how they are redistributing income. By taxing the higher income group, they are getting tax revenues which they are using to provide various type of unemployment benefits or Medicare benefits or social security benefits to the low income people. So that's their third function. The fourth function is to maintain a stable economy. The government can maintain a stable economy by increasing or decreasing taxes during recession. So if the economy is going through a recession, the government can cut down taxes. Like, recently we're going through the COVID-19 recession, government cut down payroll taxes. Okay, so that's one way they can stabilize the economy. And during inflation, when economy prices are going up very high, government can increase taxes in order to slow down the economy. Okay, so there are two different methods, fiscal policy or monetary policy, which they can use to stabilize the economy. Later in this semester we will learn about these policies, but for now, no, one of their main function is to maintain a stable economy by increasing or decreasing taxes through fiscal and monetary policy. Finally, the last economic function of government is they want to encourage and ensure competition. Again, if there is competition, what does that mean? That means output is maximized, cost is minimized, consumer satisfaction is maximized, and therefore we have an efficient economy. Okay, government wants to ensure efficiency in the market and therefore promotes competition. Therefore, if they see a monopoly, they will usually pass laws to break down the monopoly, so that there is no inefficient allocation of resources. So like in 1890, they passed the Antitrust Act or law that broke down various monopolies and created competition in the market, thereby creating more efficiency. So these are the 5 functions of the government. They provide a legal framework, they correct the misallocation of resources, they maintain a stable economy, then they redistribute income, and then they encourage and ensure competition. So you make sure you know what are the functions of the economic functions of the government. Okay, then the last topic we talk about is called taxation, which is also under the public sector, and it is a big part because nobody likes to pay taxes, but we have to pay taxes, and we pay taxes because it is the means to pay for public goods. Everyone has to pay taxes to the government, so government can use that money to pay for public goods. Okay, nobody likes it, but it's for the greater good. So everything has a cost, and public goods are no different. So even though we said public goods do not have any direct cost, but there is indirect cost, and that is through taxation. Okay, so in order for a tax system to be effective, we need to address the following questions. Is the tax system fair and equitable to all taxpayers? Is it fair and equitable? If it's not fair, many people will not pay taxes. Okay, then second one is it collectible? Is the government able to collect taxes from the people? If it's unfair, people will not pay taxes often, and it may be difficult to collect. Okay, the third question is, does it provide sufficient funds for effective government? Is the government able to collect enough tax revenue so it can provide public goods? Then does it avoid over reliance on any one type of tax? Now there can be different types of tax, right? We have social security tax, we have income tax, we have property tax, we have capital gain tax. So what it's saying is the tax system dependent specifically on the income tax, or is the tax system specifically dependent on the property tax? So it should not be over reliant on any one type of taxes. Income should be coming at a healthy amount from each of the sources. Okay, and then we have to find out, is it regressive in its effect? What does that mean is, as income goes up, is the tax rate going up or is the tax rate going down? Regressive means the tax rate is going down, but in the US we have a progressive tax rate system, which means is as your income level goes up, your marginal tax rate also goes up, and we're going to look at it shortly. Okay, so the marginal tax rate is, in the US, the marginal tax rate is applied to taxable income at 7 varied levels of defined income. And I'm going to do an example. So we have a table, we usually have a table where we have the groups of income and the marginal tax rate, and I will show you how we can calculate the tax for an individual who with a certain amount of salary using that table. Now again, you do not have to memorize that table. That table will be given to you, so you don't have to memorize the numbers, but you have to know how to use the numbers in that table to calculate the total tax that individuals pay, as when they file taxes as single versus when they file taxes as married couples. Okay, so there are two different tables, one for the single, one for the single. for the married. So let me do an example. Let's first do for single, and this is a little bit complicated and tricky, so if it's not clear, let me know. I will try to explain, but just follow the example. Hopefully it will help you. So this is for a single. Okay, for a single, if you're filing taxes as a single individual and you're not married, or you decide you want to file separately, so you're single, and then you're given with this table. And again, this table you don't have to memorize. This will be given to you, but you have to know how to use this table to calculate the total taxes. Okay, so we have the taxable income and we have the marginal tax rates. Okay, so from 0 to 9275, your tax rate is, marginal tax rate is 10%. From 9276 to 37650, your tax rate is 15%. 37650 to 91150, your tax rate is 25%. Again, these will be given to you, but I am going to write it so that we can show you how you can use the numbers from this table to calculate taxes. Then we go to the next level, which is 91151 to 190150, and this is 28%. Then we have 190151 to 413350, and that's 33%. Then we have 413351 to 415050, that's 35%. And finally the last tier is 415051 to as many as possible, that's gonna be 39.6%. Again, remember in the slide I just said there are 7 tiers of income, or there are 7 levels of income. That's what it is. If you see, there are 7. Let me show you. 1 2 3 4 5 6 7, right? So there are 7 tiers of income, and at each level, you see, at each level your marginal tax rate is different. And if you see, as your income is going up, your marginal tax rate is also actually going up. So this type of taxation is called progressive taxation. Okay, your tax rate is going up with your income, and this is for a single. So if you're filing taxes for a single, we will use this table. Now if you file taxes for if you file tax as a married couple, we will use a different table, which I will do in a little bit. But if you're filing taxes at the end of the year, then we will use this table. Now let me do an example. Let's say you're given with this table. Now we say, let's say Tom has an annual income of $40,000. Okay, what is the total amount of taxes he will pay? Now you have to use this table to calculate the total taxes that Tom will pay on 40,000. Okay, so we will go up and see, look at the table. So from on the first $9,275, Tom will pay 10%. Okay, so we do it this way. 9275, this is the first level. Okay, 75, he will pay 10%. So which means on the first $9,275 that Tom is earning, he is going to pay tax of $927.50. Okay, then but his income does not stop there. He's making 40,000. So then if we scroll up, the next level is 37,650 to 9276. If the income that he earns between this level, he is going to pay 15%. Now definitely he gets more than $37,000, so $37,650. So he will pay the 15%. So what we are going to do is, in the second tier, what we are going to do is take the upper level of the second tier, which is 37650. We will subtract the lower level, which is 9276, and then multiply this by 15%. Okay, so that is how we are going to do this. So this is a little bit tricky, but what the formula is, we take the upper level minus the lower level, then multiplied by the marginal tax rate. So this is equals to 28374 times 15%, which is equals to 4256.1. So the tax he's paying for the income between 9276 and 37,650 is 4,256.1 in a year. Now his income did not stop at 37650. He is actually making 40,000. So we have to go to the third layer, right? We have to go to the third layer, but we probably have to stop in this layer now because he's not making more than 91,150. So we don't have to go after that. If he was making 100,000, then yes, we will probably use the next layer. But in this case, he's only making 40,000. So we will stop in this level, but we are not gonna do 91,150 minus 37650 because he is not earning that income. He's only earning up to 40,000. So what we are going to do is we are going to use the maximum income he's making, which is the third layer. We will do is 40,000. That's the income he's earning, minus the lower level 37651 times the marginal tax rate in that layer is 25%. We are using 40,000 here because that's the maximum, that's the total income. He is not earning more than 40,000, so he will not pay taxes on income more than 40,000. Okay, so if we do that, 40,000 minus 37651 is 2349 times 25%, and that is equals to 587.25. Okay, so now we know the different levels of taxes, and then we calculate the total taxes he paid. So total taxes he's going to pay is going to be 927.5, which is coming from the first $9,276. So 927.5 plus 4256.1, which is this number, plus this number, which is 587.25, which is, if you add up these numbers, we will end up with 42561.1 is 5770.81. So out of 40,000, he has to pay tax of 5770.81 if he's filing as a single. So it is a little bit complicated. We don't have to memorize the table. This table will be given to you in our homework or in an example, but you will have to use this table, and I will give you an income. You have to use this table to calculate the different taxes that he will pay at the different levels, and then add them up to finally calculate the total taxes that he's going to pay for this income. Okay, so that's single. That's when you're filing for single. Now let's say we look at married. Okay, so the table is different for married, and you will see it's actually more beneficial if you file as married because it's for two people, so the levels of income are more broader. You know, it will cover more level of income in at each level. Okay, so let's say again, this is taxable income. This is the table I'm doing for married. If you file as married, and then marginal tax rate. Okay, so let's say taxable income is between 0 to, this is the first level, and we still have 7 levels. Here it's 10%. Then from 18,551 to 75,300, it's 15%. Then from 75,301 to 151,900, it's 25%. Then 151,901 to 231,450, it's 28%. Again, you don't have to know this, but I am doing this so that we know how to calculate at each level. Okay, then we have 231 to 450 to 413,350, and that's 33%. Then we have 413,351 to 466,950, that's 35%, and anything above 466,951 is 39.6%. Okay, again, there are 7 layers. If you see 1 2 3 4 5 6 7 layers, and each of the layers have the, as the income level goes up, your tax is going up. As income is going up, your tax is going up. So we have progressive taxation. But one thing to notice, which is very important, is if you see you know, under married, your taxable, you know, the levels are broader. You know, the level, the income that it's covering are broader. Okay, so same way, let's say, you know, let's do a quick example so we can do it easily, you know, and so you know how to calculate. Let's say Tom earns $20,000 annual income, and his wife Stacy earns $30,000. What is the annual tax they are going to pay if they are filing as a married couple? So if they are filing as a married couple, their total income will be 20,000 plus 30,000. So we will go up to 50,000. So again, we use the table. So let's go up. So on the first 18,550, first level, 18,550, they will pay 10%. So that's equals to 18,555. Then we go to the second level. Second level is, we will, now second level is 75,300 is the maximum, but they are not earning, even together they are not earning 75,300. They're only earning up to 50,000. So we will use 50,000 as the upper limit. So 50,000, because that's the max they're earning, minus 8,550 times 15%. Okay, so that is equals to, sorry, 8,551 minus 15%. So if we look at it, 50,000 minus 18,551 is 31449 times 15%, which is equals to 4717.35. So the total taxes they're going to pay is, we add the two numbers again, this plus this, so 1855 plus 4717.35, which is equals to 6572 0.32. So that's the total tax they are going to pay if they are filing jointly and the income is $50,000. So hopefully now you know how to use the table. I know it's a little bit complicated, but if you follow through the example, you should be fine and you should be able to calculate any problems I give you. It's a little cumbersome, but if you follow the steps right, you will do it correctly. Moving on, there are a couple more concepts that the book talks about. The first one is called the benefits received principle. What it says is, what this principle states is that only the people who receive the benefit should repay the taxes. Not everyone should pay the taxes. Only the people who receive the benefit should pay taxes. An example of this would be the toll roads. Whoever is using the toll road, they will pay the tolls. If you're not using the toll, if you're using the local roads, you don't need to pay tolls. But this cannot be applied universally. It is very difficult to apply universally. For instance, let's say if the government is providing free education, they are providing high school free education, and they are providing upper education as public good, then how can government impose taxes on the students and not anybody else? That wouldn't be fair, right? If they are providing free public school and they are imposing taxes on students, it won't be fair. People will not go and learn, people will not go to schools and colleges, and they will not get education. So this system cannot be applied universally, as tax can become burdensome to some groups. So everyone needs to pay taxes. Now there are three different classification of taxes. The first one is progressive taxation. That's what we have in the US for the income taxes. So what that means is, again, as your income level goes up, your marginal tax rate also goes up. So the additional tax rate that you pay on the income goes up with your income level. Okay, an example would be your US personal income taxes. The second one is called proportional tax rate. This is basically a flat tax rate that is applied to all individuals regardless of their level of income or wealth. So let's say property tax is an example. 3% of the value of your home. It does not matter how much income you earn or how much your total assets is. It depends on the value of your home. So 3% flat on your value of your home. So that's proportional tax rate, and that is basically a flat rate applied to the value regardless of income and wealth, and property tax is an example. Then we have regressive taxation. What that means is your marginal tax rate actually goes down as your income goes up. So as your income goes up, you're actually paying less taxes. An example of that would be sales tax or payroll tax or social security tax. So again, if you are social security taxes are only applied to a maximum amount of $127,200. So if you're earning $200,000, you're still going to pay the same social security taxes if you are earning $127,200. So as your income goes up, your taxes are actually going down in this type of situations. And examples again would be sales tax, payroll tax, or social security taxes. Okay, now this is important. This is marginal tax rate versus average tax rate. So marginal tax rate is basically the change in taxes divided by the change in income, whereas average tax is the amount of taxes paid, total taxes that you paid divided by your total income. So let me do the formula and let me show you examples, quick examples of how to do it or how to calculate these. Okay, so marginal tax rate is calculated using change in taxes divided by change in income, and average tax rate is calculated by using total taxes paid divided by your total income. Okay, so let me do two quick examples, and I promise I will probably take another 10 minutes and I should be done. I'm combining two lectures, so that's why this video lecture is a little bit longer, but hopefully it's for the good of everyone. Okay, so let me do an example. Okay, so let's say your income, your annual income, your annual total income is $10,000, and the total tax you pay or you paid is $1,000. What is your average tax return, or what is your average tax rate? So ATR is, again, if you look at the formula, is your total tax paid. So in this case, the total tax you paid is $1,000 divided by your total income, 10,000 times 100. You have to do 100, you have to multiply by 100, even in case of marginal tax rate, because it's a rate. Remember, it's a rate, so we have to multiply by 100. Okay, so if we scroll down again, you paid total taxes of 1,000, your total income is 10,000, you multiply by 100 because it's a rate, and you end up with 10%. So that's average tax rate. Okay, now how about marginal tax rate? Let me do an example of marginal tax rate. Okay, say your income increases from $10,000 to $15,000. Let's say you get a promotion and your income increases from $10,000 to $15,000, and the amount of taxes you pay go up from 1,000 to $2,000. Okay, what is your marginal tax rate? Meaning, when I'm saying what is your marginal tax rate, that means what is the extra tax that you're paying on the extra income that you're earning. I know on the first 10,000 you were paying 10%, but what is the extra tax you're paying on the $5,000? So what is that extra tax rate that you are going to pay on the additional income that you're earning? Your additional income in this case is 5,000, 15,000 minus 10,000. That's the additional income you're paying, and what is your tax rate on that additional income? So we again know the formula is the change in income by your change in taxes divided by change in income. So marginal tax rate, your change in taxes, is $2,000 because now you're paying $2,000. You were paying $1,000, so 2,000 minus 1,000 divided by your change in income is 15,000 minus 10,000 times 100, because it's a rate, we have to multiply. So we have 1,000 divided by 5,000 times 100, and that is equals to 20%. So basically, on the extra 5,000 income, you are paying 20% taxes, and that's your marginal tax rate. Okay, on the first 10,000 you paid 10%, but on the extra income you're earning $5,000, you're going to pay 20% because you're paying higher taxes. So on the extra income you're paying 20%, and that's an example of progressive taxation also. As your income is going up, your tax rate is also going up. So that is how you will calculate average tax rate and marginal tax rate. Okay, then last couple of concepts. Tax incidence, which means basically describes who actually pays the tax. Some taxes may be shifted away from the intended party to someone else. So for instance, if the government imposes corporate taxes on business, what they will often do, the businesses will increase the price of the goods also. So they will shift the burden of the taxes onto the consumers, and that is called tax incidence. Who is taking the burden of the taxes, so that's tax incidence. Then we have tax loophole. Tax loophole is basically a tax reduction that is built in our federal tax code for individuals or corporations. So these are some reductions or some mechanisms that are provided by the government in our tax system, so that individuals and businesses can take some deductions and they have to pay lower taxes on the total income they earn. For instance, tax codes allow, if we own a home, we can deduct our property taxes and our interest payment on the loan from our total salary or total income, and therefore our total income goes down, and therefore that tax that we pay is also goes down. Now, tax loophole is legal. This is like a kind of incentive the government is providing us because we are paying less taxes. But tax deduction, tax evasion is completely different. That's what you owe taxes and you're not paying it, so that becomes illegal. Okay, so that's not the same as tax evasion. Tax loophole is the name might sound weird, but tax loophole is basically a mechanism that the federal government has provided us to take some tax deductions so we pay less taxes. This slide gives us a breakdown of the federal government, where they get their money from. 46% comes from personal income taxes, and then using the tax revenue, federal government, 37% is used for income, 22% is for health, and so forth. It's just for informational purposes. And the last slide, finally I'm there, is the term is called fiscal federalism. This means when the federal government shares their tax revenue with the state and local government, okay, for poverty, health, and highway programs. So that's fiscal federalism, when the federal government is sharing their tax revenue with the state and local, right? Like right now, during coronavirus situation, the federal government is providing funds to the state government. That is fiscal federalism. Okay, government has two ways to spend the money. They can do transfers or they can do purchases. Transfer payment is government spending for which nothing is directly received in return, such as subsidies to farmer. Government can also make direct purchases of goods and services from a company. So these are two ways they can share revenue between states, local, and other government entities. So that's the end of chapter 4. I know it was pretty long. I'm sorry about that, but it covers 2 of your lectures, lecture 6 and 7. And that's it. After that, we have the midterm exam coming up next. So I will be sending out a review, so you guys make sure you look at the review and go over the lectures and my video lectures, and I think you should be good for your exam. If you have questions, send me email, but otherwise, good luck, and I'll be back soon. Thanks.